Welcome back to the Calzone, Bryan Brady.
Hey,
Good
what's
to
up,
have
guys?
you, dude. Brian, and Ben and Cal.
I know.
On the Calzone, dude.
We made it.
In the new studio. We've got some stuff to clean up, dude. But I love this new home. I love this new home for the Calzone.
Yeah.
For sure.
Yeah.
Brian brought you on today to talk interest rates.
Yeah.
What are they doing? I heard they're getting a little bit better, but they're sporadic, right? They're pretty volatile. Everything all over the place.
Yeah, it's been a really interesting time in the market because interest rates, they start the day off and we're down 20 basis points, and then 15 minutes later it's up 30, and then so this volatility that we're seeing, it's been in the market since 2020, March of 2020.
Podcast, get that thing in your grill.
Sorry, yeah, 100% first time on a podcast. First time.
Me too, dude.
The only camera I've ever used is my iPhone camera.
Put that Bruno
Bruno mic,
Mars
I'm like,
mic
I just didn't know
right
what
up
to do
against
with
you.
it. Yeah, right. So yeah,
Sorry to cut you off.
no. It's trust me, I need the help. So yeah, there's been a lot of volatility. We're in a good trajectory right now. We had the big jump in November that we had talked about on
Right.
the Calzone 4 months ago.
Yeah.
And that was a really cool one-day gain, and I'll show you guys that on the graph really quick. And we had gotten better. Then February was just a rough month for us, right? There was the big jobs report that came out. The inflation numbers weren't going down like we wanted to see, and so February was rough. March has turned around. We've made back about half, maybe a little bit more than half of what we lost in February. So we're still not as good as we were in January, but we're working our way there.
Right.
And things look good down the road, right? So really quick, I've got these two graphs pulled up for you guys because I track the mortgage-backed security, which is on the left-hand side, and
Oh my god, that word scares the shit out of me.
most people, right?
Well,
Ever since The Big Short.
A lot of
The Big
people
Short.
don't remember.
Yeah, right. So with the mortgage-backed security, right, this is what dictates where our interest rates are going, the demand for the mortgage-backed security. 90%, maybe closer to 80% right now of home loans get securitized and sold in a bundle onto the secondary market. If there's demand for that bundle, our rates get better. If there's no demand, our rates get worse because it's the yield that, the cost that they're going to get back, the yield they're going to get back for giving the money over for the mortgage-backed security. So,
Can I just?
Yep.
I just have a question. So, is the demand for that kind of twofold? Is one side of that demand, AAA, obviously meaning the better the bundle looks as far as who is taking on those or who is asking for those loans and the rates that are inside the loan?
yeah, for the majority, it's going to be the rates.
Okay.
Right. So it's, yeah.
Okay.
So they're still going to be packaged to the point where, right, the theory is that once you put, and there's going to be tranches, but once you put 1,000 loans in, the risk is diversified enough that really you're looking at, this is the yield that we're going to offer straight up, and then see where the market dictates it goes. So the price on the left-hand graph is what we're looking at, and the yield is what we're looking at on the right-hand graph, the 10-year treasury. I've got these pulled up because there's a pretty good inverse relationship with these guys. The price, as the price goes down, that's going to increase the yield. So if you could flip the graph on the left, it would look very similar to the one on the right. It's the, peaks and valleys are a little bit elongated on the mortgage-backed security graph, but there is that volatility and there have been some really big swings. So the reason I've got it up here is I have to pay for that information for the mortgage-backed security. That 10-year treasury bond is on CNBC. So anyone that's like, hey, what's going on with interest rates? If you go on CNBC, it's not 100% correlation, but it is a very, very good correlation for what you're going to be looking at for interest rates. So, down 9 basis points on the 10-year today. We were up 20 basis points on the mortgage-backed security, which you can't see that on that graph, but that's just me knowing that. So,
So if you're looking to see what the rates are doing, you can check out the 10-year Treasury
every single time.
and
you get a really good
get
idea.
pretty close.
Yeah. So that's really what I tell my borrowers. I'm like, hey, listen, if it's going to be a month or two that we're going to be shopping around and you want an idea of what's going on with interest rates, always you can call me. But if you're just, sitting on your phone, don't want to,
I call you every
talk
time
and text
because
me.
looking at this, dude, I'm blanking out right now. I see numbers, I see graphs. My brother's the number guy in the family, dude. I call Bryan and I say, "What's the rate today?
Where are we going?
What's it doing, and where's it going?" But I thought that it would be cool to have him on here and show the correlation between the 10-year Treasury and the stuff that he pays for to look at to actually lock in a rate.
Yeah.
And maybe dive into that a little bit, Bryan. What are your thoughts right now on locking loans? Let's say we put somebody in contract today.
Okay, good. It's a great question.
Take them through like when you're thinking about locking that loan or what you're looking for to convince yourself that it's a good time to talk to them about locking their rate.
Right. So that's a great question. It's a great
Thank you.
segue. Yeah, very very good. Awesome. So what I'm looking at when I have a borrower, first and foremost, is how long do we have until the close of escrow, right? Especially right now, because rates are still really elevated. We're still up in the the high 5s and 6s. So, and that's you're getting into the 5s. It's costing points to get there.
Right.
So we're still really really elevated, but because inflation runs on a 12-month cycle, right? It's an annual number, a year over year.
Right.
What we're looking at is when are we going to project that inflation is going to get better, right? Everything's in a bubble when we talk about that. So if I've got a deal that's 3 months out, I'm just going to hold off right now, because in the intermediate term or the 60-day plus, I'm going to sit there and say, hey, that inflation report that comes out May 9th is going to be, or is projected to be, a really good number for us.
Right.
So that's kind of
compared to last year.
Yeah, that's exactly. So like last year, the CPI number was, it went up like 0.6%. And, we've been at 0.3, 0.4. So, that the annualized number should come down going into May, and then June, July was also high. So hopefully that's the beginning of us going this way with rates.
Right.
In the short term, anyone that says they know what's going to happen on a daily basis is just so far out of their mind. So much stuff happens that affects our interest rates.
Right.
That jobs report, that came out in February, was just horrible. The way that they messed with the numbers, and you've got people like Barry Habib sitting there going, yeah, but the real number should have been like 80,000, not 517,000. And it's like, oh, okay, cool. So we're messing with the numbers, making these adjustments, and it continues to hurt the market.
Right.
And then, I'm sitting there after that and I'm like, well, but it's a BS jobs report. Things are going to get better. The Bank of Japan, the head of the Bank of Japan was stepping down, and the person they expected to replace him, who was very dovish, said he didn't want the job. So like 2 days later, the market just tanked again on us. And it was like, okay, no one saw that news coming out today.
Right.
So anyone that says, oh yeah, in the short term, this is what's going to happen. No, we don't know. So what I do with my clients right now is I say, hey, this is where the rate is right now, right? We're going to talk about it before we write an offer. Say, this is what we'd look at today for a payment with the rate today. This rate can go up tomorrow. It can go down tomorrow. It is a casino. It really is right now.
Yeah,
when you're talking day in and day out.
If you like the William Hill app,
this is, right?
You should be a lender.
Yeah, right. If you like pulling out your hair at 7 o'clock in the morning, be a lender.
Need that Hawaii Chase game, dude.
What you guys don't know is these guys were lenders. They ran out of hair to pull. No, so it is just like right now I say, hey, short term, I don't know what's going to happen. If you're happy with the rate right now, that's what I would do. I would lock in. If it's 30 days or less, like, hey, let's not mess around.
Right.
Let's lock it in.
Right. Because we know what today's is.
Yeah, exactly. I know what today's is. I don't want to see a big red day where we lose 100 basis points and then all of a sudden your payment's $35 more per month for the same costs, or your closing costs go up. Because with the volatility, we literally will have days where on a $400,000 loan, we're moving, $2,000 on cost for rate.
Right.
Right? Like if the rate, the day before was 6% with 1 point, and all of a sudden, we drop 50 basis points.
Right.
And what's the rate today? Well, it's 6%, but it's going to cost $2,000 more to get that out of pocket. And hopefully we can come back from that. But, that's the problem that you get into with trying to time the market, right? If you could time the market, man. The problem that you get into is you have months like February where it's a steady decline, and all of a sudden you're looking at 200 basis points worse than we were talking about 3 weeks before.
And it happens so fast.
So fast.
So I have a question for you.
Yeah.
It sounds like and excuse my language, I'm going to swear a lot on the calzone.
That's
okay.
fine.
We're sailors.
Yeah, that's fine.
I'm thinking it sounds like a complete fucking gamble. And so my question to you, Bryan, on that is, obviously you can't predict it, and these buyers are coming to you for guidance on this. Mm-hmm. Are you able, number one, are you able to give that guidance, and number two, what kind of guidance are you giving? I heard what you guys just said, and I completely agree. Right, we know what the rates are today.
Mm-hmm. Yeah.
So I don't know if you can speak to that a little bit.
And so, right, like that because,
that's why I said it sounds like a gamble, right? Like me thinking about it's not something I want to deal with.
Yeah, 100%. I get it. And there's trade-offs, right, with the market when you talk about, the high interest rate and what you're going to have to pay for that interest rate. The trade-off is, prices did come down for, 7-8 months in a row?
Yeah.
Before we kind of flattened out, and now it looks like we're going to turn back that trajectory with the spring coming. It is a gamble. 100% it is a gamble. The thing that I'm going to tell my clients right now without fail is the rate is what the rate is. It's not something you're marrying the home, not the interest rate, right? The goal isn't to get in and keep this loan for 10, 15, 20 years. The goal is to keep this loan for 12 months max, right? When we look at historical interest rates, we know that in a recession, rates get better. And in like 6 out of the last 7 recessions.
There's another scary word.
Yeah, I know, right? Honestly, I would argue that we've been in a recession, and we can talk about the yield curve inversion.
Dude, I was looking at it today, and we
I think we talked in November.
We get those emails from Elliot Eisenberg, the Bowtie Economist.
Yeah.
If you haven't signed up for
they're so good.
Little blog that he sends out, dude, sign up for it. It's incredible. But in the one that he sent last night, he's like, which means he ended it by saying something about which means recession is coming.
Harder to avoid recession.
Right, yeah. And I'm like, dude, I thought we've been in it for 6 months now.
I would argue that we have. At least our industry, we definitely have.
I've been using my crock pot a lot more, dude, which means
we started cooking at home.
Recession, dog.
Yeah, we started cooking at home, being real smart about where we spend it. Our industry 100% has been in a recession.
Right.
100%. I mean, just like, airline pilots, lost their jobs and lost their income in 2020 when they couldn't fly.
Right.
Recessions hit different industries at different times. I would argue that we were one of the first industries to get hit because with mortgage-backed securities, we're all based on investor sentiment. So the Fed continues to raise rates, but our rates have actually gotten better. So you're sitting there and you're going, okay, when rates do start getting better, when inflation shows that it's going to, it's on a trajectory to go downward, which I'm really hoping could be in March that's a really big day for us. We've been looking at it since November. And November was that really big green bar. We had like a 200-point day in the market where the inflation came out and it was like, oh yeah, that guy right there. Inflation report came out and it was the biggest one-day gain I've seen. It was awesome.
I don't want to go on a huge tangent because I don't think our listeners are really going to care. But this is where I'm going to bring in some of that, like, some of the investor side of things, right? Where I think about, like, hey, maybe, I'm not sitting in that real estate mode where I'm like, okay, things are going to, like, I want things to get better, and I
Yeah.
hope I'm wrong. My only pushback to what you just said about rates getting better, right? So rates are going up,
Uh-huh.
Fed funds rates going up, but
Yeah.
interest rate for home loans is going down.
Yeah.
We've never seen, well, I can't say never, right? But we had interest rates going up in the same week we had quantitative easing happening.
Yeah.
Because they were bailing out banks.
Mm-hmm.
So do you feel like there's any correlation to that and seeing rates kind of subside because there was liquidity injection in the system?
Yeah.
Again, we don't have to go
100%
crazy
there.
down a rabbit hole on this.
I'm lost.
That's
Yeah.
what happened. That was 2020, right? When they started doing QE and they
happened
started
last
buying
week.
bonds. I know. And
This
then
happened
with the banks, yeah, right, with SVB, that they did the same thing. I think it came out that the Fed had given like $40 billion to open up their short-term window. And it's like, well, why would any bank go to the Fed for that money? Because that money's not cheap in the short-term window.
I think
But
it completely goes to you have no idea what's going to happen, right? So something
Yeah.
that's not necessarily good for the overall system, right? Lowers rates, and it could be a good time to lock in a rate, right?
right? And really, what you're going to see, the thing that where I would come back to is inflation has a direct correlation. The correlation between inflation and interest rates is fairly direct. So, if we can predict where inflation is going to go, that is really going to be helpful for us. And when you talk about what makes up core CPI, 43% of that number is shelter expenses. Rents have been going down since for about a year. So that number that we're looking at for your shelter costs on a 12-month moving average is coming down. And with that making up 43% of the cost, that's going to help us. Right? So that's a really, really big component of what makes up the inflation number that I see getting, in May, June, July, right? That's what we're hoping for, at least. The big thing that I would say is it's in a bubble, right? If the Fed goes out and does something that's pretty airheaded, or Putin drops a
Let's
nuke,
call it a vacuum.
like that,
It's in a vacuum, right?
Yeah, in
Not
a
a
vacuum.
bubble. Let's stay away from the word bubble.
Okay.
But
I didn't even realize where you were going with that until you went.
well, dude, you guys are both smarter than me, and I'm just sitting here listening back and forth, and I hear the word bubble, and I'm like,
I get
gotta
the same
listen
way when I hear
again,
mortgage-backed
dude.
security, recession,
Right.
all these like buzzwords.
Yeah, but so that's where we're at. Like short term, I would say lock it in as soon as you can.
Right.
Mid-term, long term, you can hold off. The loan that you get today isn't the loan you're going to have 2 years from now.
right.
You can almost guarantee it. I can almost guarantee it, because if that is the case, I'm not going to have a job in 2 years. So, it's an interesting time to be in the market. That's definitely something I'll say. But it has really helped to, weed out some of the competition that we've had over the years. And it helps you to streamline your processes. Like,
Right.
in 2020 through 2022, 2021, end of 2021, beginning of 2022 is when we really started to feel it. I didn't have much time to work on my processes.
Can I say something that I
Yeah.
thought was pretty interesting, and you can verify this, but I believe you and I talked about this the other day, where the banks right now, correct me if I'm wrong, are incentivizing not terrible credit scores, but lower credit scores over higher credit scores.
FHA stuff.
Yeah, so
I think
that
that's
was
interesting, right? Because when we think of credit scores, like, oh, I'm in the sixes, like, I'm scared, right? Like, we hear that from buyers.
Right.
And,
honestly, I think it was really, really, really just a cash grab by the FHFA. Because we were talking about this the other day with the changes that got made to conventional loans.
Right.
So it used to be, if you had over a 740 credit score, you were prime, right? You were getting the best rate that you could. And then the rates changed based on down payment as well. And not always the way that you would think. Like if you put 15% down, you actually got a little bit better of an interest rate than when you put 20% down. Why? I don't know. Because, it was the lender making room for the MI that you were getting added in at 15% down. So So basically Fannie and Freddie, right? FHFA is the governing body of Fannie and Freddie that oversees and creates the rules for them. They changed the pricing model that we have. They said, 740 is not prime anymore.
Who is the most popular person on the planet?
That guy. I'm like, yeah, cigar club. That guy.
I haven't gotten that many texts today.
I don't think I've gotten that many this week. If you take my wife out, I definitely haven't.
I don't think they're text messages. I don't know.
No, dude. What was it? What were we?
FHA.
Oh yeah, the FHFA. So it's not the FHA actually made their loans a little bit cheaper. They cut their mortgage insurance. The FHFA made conventional loans more expensive for your person that comes in with 5 or 10% down with a 740 or a 760 credit score. Like literally 3/4 of a point more on cost for their rate, which, if you're a $400,000 loan, that's $3,000. It's a cash grab.
Right.
And they say, we're going to open it up for, 680 credit scores are now it's not going to cost as much for you to get a conventional rate. Yeah, but your mortgage insurance is going to be way higher than the FHA. Your out of pocket is going to be way higher than the FHA. You're still going FHA if you're at a 680.
Right.
So there's no real incentive unless you're saying I'm 680 with 20% down. That's like the instance that it works.
Okay.
It also did help investors. If investors are putting 35, 40% down, the LPA's dropped way down. So
Cool.
Makes sense, right? Because we had this big push in 2020 to prioritize first-time home buyers and prioritize primary residents.
Right.
Now we're going, hey, let's make it a little easier for investors. I don't know.
I don't know. Who's making these rules, man?
Someone smarter than me, I think.
Hopefully.
Awesome.
most definitely, right?
We can only hope.
I like the new setup. I like this a lot.
So recap, dude. Prices are all over the place. If you want to check out what the rate might be today, or check out the volatility, like seriously, just go check out the 10-year Treasury, and you can see just how volatile it is and what Bryan has to deal with every day. Bryan and all the lenders in town have to deal with every day as far as when to lock a loan and stuff like that. It might. What else did we talk about? It might cost you less if you have a bunch of money, but your credit score sucks. And it might
cost you more if you got great credit with a fairly decent down payment. But that's why we'll go through, with all of our clients, we go through all of the options. Honestly, I had someone where made good money, so didn't qualify. They've come out with these, if you make less than the area median income, they'll waive LLPAs for first-time buyers. Or if you're under 80%, you can get the LLPAs waived. Well, if you have a borrower that is not a first-time home buyer, makes pretty good money, but doesn't have a huge down payment, 760 credit score, FHA, less out of pocket, better interest rate, less monthly.
The house has to be cleaner too.
Yeah. So
FHA appraisal's not gonna. I mean, we'll
go to appraisals next.
But, I'm gonna have to run around.
Decompress for a minute.
Yeah.
Do some push-ups or something.
Just do something, dude. Hit a heavy bag or something.
Yeah.
Before I start talking about appraisals.
Yeah.
But I think. What do you got here, Ben?
I was just looking at all of the bonds and the treasuries. I think it's pretty amazing right now that you can get almost 5% on a 4-month treasury. This is the investor in me that's like,
right.
That's pretty damn good. You're making 5% on your money in 4 months.
For real.
Yeah.
Right, and then we look at the 2-year, which is kind of crazy too, right? We're only 50 cents away from where the 10-year is. So that inversion, right, that you're talking about a little bit, Bryan, that spread's getting closer and closer together, which is good and bad, right?
Yeah. So we maxed out, I believe it was March 9th was when that inversion was at its highest point, which was like basically 1.03%, which is crazy.
I think we can even look at it.
Yeah, so that's where I'm talking about. Yeah, 1.07. So that's a really crazy inversion and basically what you're looking at when you're talking about the yield curve and the inversion is the normal yield curve is going to be, right, the shorter term bonds are going to have a lower payout, whereas the longer term bonds should have a higher payout.
Right.
The curve goes this way, right?
Which is normal, right?
That is the normal. That's what we want, right? Right now, we worked our way from here to flat to the negative. And so once it goes negative, that is what they've shown. It's an indicator of recession, right? About 6 months to 3 years after you have the dip, we start a recession. April of last year was when we last dipped before this big,
That's when I pulled my crock pot out.
Yeah, that's when you started getting smart. But what we're looking at when we talk about that is it's really just the risk profile of the market in general at that point in time. People are pulling their money. They want to be liquid. They don't want to be in the bond market. So what they have to do is to incentivize people to buy that bond is increase the rates, right? That actual purchase price is going down. And it's just more of that same, price to yield that we were talking about earlier with mortgage-backed securities.
Right.
So, people aren't going to invest in the short-term stuff, but they expect the longer-term stuff for rates to normalize. That's why you get upside down with that inversion. Right?
Makes sense.
So, and that's because it's all renewing that much faster than the long-term stuff.
Right.
So, super, super fun.
Radical, man.
Yeah.
Well, thanks for coming on, dude.
Yeah, that was awesome. And
What do you think about your Bruno Mars mic?
I don't know. It's like, get it closer, Brian. And I'm like, I don't want to. I'm like, maybe we just,
Just put it close to your lips,
just
dude.
get it up in here. Just get right here. Okay. No, I love this setup, dude.
The gold member.
Right? It's the guest mic.
Put the gold member close to your mouth.
Just hold it right there.
I'm such a child, dude. All right, we're out of here.
Yeah. 36
Thanks,
going
Brian.
on 13. Right? Gotta love it.
Cool.
That was fun.